In this case study, we're looking at Germany's current account balance. They've had a series of surpluses and deficits. So let's have a look at this first diagram. And I'm really going to start looking at this diagram from the 1980s onwards. So in the 1980s, Germany was running these very large current account surpluses. On the vertical axis, the surpluses are measured as a percentage of GDP, which is a fair way of measuring a surplus. Obviously, the size of the economy, most economies gets larger each year. Current account deficits may get larger each year. So you want to measure current account balances relative to GDP to adjust for changes in sizes of the economy, to adjust for changes in the size of the economy. So most of the 1980s, we've got these quite large current account surpluses. Now we can view that mainly as being a result of Germany exporting a lot more than it's importing. And that kind of makes sense. Right throughout the post-Second World War period, Germany has really turned itself into an industrial powerhouse. And a classic example of what Germany exports is motor vehicles. We've all seen German cars on Australian roads and around the rest of the world. They also produce a lot of locomotives for train industry and a lot of advanced manufacturing as well. So it's unsurprising that Germany has been running large current account surpluses for most of the post-Second World War period. But these surpluses really did increase in size relative to GDP in the late 1980s. Then something interesting happened. In the early 1990s, the surpluses went from the last surplus, and I think that's about 1989, was just under 3%. It went from a 3% surplus down to about a 1.5% deficit. So this is a massive change. Yes, changes have occurred like this in the past. So around about 1980, there was a swing from surpluses to a couple of deficits, but it's the size and the sustained nature of these deficits in the 1990s that's quite interesting. So we had a series of sustained large surpluses in the 1980s, and all of a sudden a swing to large deficits year after year after year. So this is quite a change, and this change at 1990 from surpluses to deficits, it looks very different from what happened in the 1980s. And so the obvious question is, well, what caused this big movement from current account surpluses to a series of current account deficits throughout the 1990s? Could it have been that all of a sudden the rest of the world stopped buying Mercedes and BMWs? Or could it be that the Germans all of a sudden, from one year to the next, decided that they wanted to massively increase their imports of foreign goods, maybe go on holiday somewhere overseas? Neither of those is likely to be the explanation of this movement from large surpluses in the late 1980s to large deficits. To understand this, we need to go back to our savings minus investment equals current account balance equation. And so what we've got in this diagram is the current account balance going from a surplus, so where S is greater than I in the late 1980s, to a current account balance which is negative, so that in the 1990s, savings is less than investment. So what could have caused that? Well, the answer is, in 1990, it was the reunification of West and East Germany. That occurred in late 1990. So it's no coincidence that this substantial, I guess, political and economic event swung the current account balance from surplus into deficit. So for that to occur, the S minus I line must have shifted to the left. The exchange rate would appreciate, and the level of net exports would fall, would go from, say, some positive number to some negative number. Hopefully you can visualize that without me drawing the diagram for you. So then, okay, so what would have caused the leftward shift in the S-I line at 1990 as a result of reunification? Well, the first thing that happened is the German government started running larger government budget deficits to actually fund a lot of infrastructure spending that was required, particularly in East Germany, which had lagged behind West Germany for decades, to try to get the East German economy up to speed. So what we can see here is, in this second diagram on the right, is the German government budget deficit in the 1980s averaged around about, and I'm just looking over this period here, 1980s, averaged about, let's say, 14 billion euro. Then in the 1990s, the amount of borrowing required by the German government to fund reunification really increased. That then led to or paid for more infrastructure spending, more government spending in general, and larger government budget deficits. And so in the 1990s, if you average the government budget deficit there, it's gone from about 13, 14 billion a year to about 25 billion a year. So remember, I, in the S-I equation, I is our proxy for total borrowing. So this is showing us that in terms of government borrowing, I has actually increased, which would help shift the S-I line to the left. But it wasn't just a government story. What happened at the public level, so the household company level? Well, gross savings in the 1990s, that was actually falling. So that certainly would have contributed. So household savings were falling. And the big one was a big increase in private investment, starting off there, or just probably starting off about 1988. The Germans already knew that reunification was on the way. So this story of a surge in investment spending just prior to reunification in 1990 was all about German companies getting ready for unification, knowing that new markets would open up in the old East German part of Germany. And so companies wanted to be prepared for those markets, those consumers, to be opened up to the West. So that explains the big surge in investment spending, and that surge lasted for almost a decade before investment spending plummeted in about 2000. So we can see that there was a large switch from savings being greater than investment to savings being less than investment. And that switch occurred at 1990, which makes perfect sense and is perfectly consistent with the current account balance going from deficit to surplus. So not only was the government borrowing more in this diagram, but at the private sector level, and when I say private sector, I'm talking about households and firms, savings were falling and investment spending was rising. And as I said, a lot of this additional investment spending was due to reunification. A lot of the additional government spending, government borrowing, was a result of reunification as well. Okay, so then we would also expect the exchange rate to appreciate, which would have been consistent with this switch from S being greater than I to S being less than I, and a drop in net exports. So just before we have a look at the exchange rate, let's have a look at what was happening between the late 1980s, when there were large current account surpluses, and the early 1990s when there were current account deficits. Let's use our model to model what was going on. And this is what was going on. We know that savings were falling. We can see it there, gross savings. And we know that borrowing by the private sector for investment and by the government to finance government budget deficits, we know that total borrowing, was increasing. So if you've got S falling and I increasing, you're going to get a leftward shift in this line. You're going to get an appreciation of the exchange rate, and you're going to get a big drop in net exports from a current account surplus of, say, 60 billion to a current account deficit of 30 billion. Now remember, what happens in this model is when this vertical line, the S minus I line, shifts to the left, what drives net exports and the current account balance into deficit is a big appreciation of the exchange rate. So did that happen in Germany? So finding the correct exchange rate data is not easy. It's a long time ago, but I was lucky enough to find this. And so this is, you can have a look at it down here in the legend. This is the real effective exchange rate. So this is an exchange rate which has been adjusted for price level differences in Germany versus the countries it trades with. And I think it also might be a trade weighted average exchange rate. But what we can see here is a large appreciation of the exchange rate in Germany, starting from about 1992, about that point, through to about 1996, 1997. And then it stayed quite high, the exchange rate stayed quite high compared to the 1980s for the entire 1990 period. Yes, there was a little bit of a drop here in 1998, but on average, this exchange rate in the 1990s, the German exchange rate, was much higher than it was in the 1980s. So we can see some evidence of a higher exchange rate there in Germany, which would then can be modeled in this diagram by this appreciation here, which then explains this big move from current account surpluses to current account deficits. If a country is going to experience a large appreciation like this, it's going to drive the level of the country's net exports down. Okay, going back to this diagram, the next interesting feature of Germany's current account is this massive swing from current account deficit in 1999 to massive current account surpluses from 2000 onwards. So how do you explain that? Once again, it was triggered by a particular economic event, because the euro currency was introduced in January 1999. And so somehow the introduction of the euro has led to Germany moving from running current account deficits prior to the introduction of the euro to massive current account surpluses after the introduction of the euro. And these surpluses are absolutely massive. And those surpluses still exist today. And they are a real problem for Germany and for the rest of Europe. So I guess the next question is, how did the introduction of the euro lead to Germany moving from current account deficits to large current account surpluses? Well, once again, we go to this model to explain, and hopefully you're beginning to appreciate this model a little bit more. I told you at the beginning of the course, once we understand this model, we can do a lot of interesting things with it. Well, in modeling the movement to the euro, we can start here at point A, and point A is the 1990s, when Germany operated using the Deutschmark currency. And then what I'm saying is once the euro was introduced, Germany moved to point B. So what I'm actually saying here is relative to, oh, don't worry about this Australian dollar per $1 US, I missed that. Yeah, this is just the German exchange rate. It's a little bit of a typo there. That should be the German currency per $1 US. That doesn't matter. But what I'm saying is that when the euro was introduced, the euro relative to, say, the US dollar was a weaker currency. I'll say that again. Relative to the US dollar, the Deutschmark was a stronger currency than the euro. And to understand that, you've got to ask yourself, well, what does the value of a country's exchange rate represent? And the answer is an exchange rate is a reasonably good barometer of the health or the level of economic activity of a country's currency, of a country. It's a good barometer of the level of economic activity of a country. So how does that work? Well, let's just imagine in Australia, we go through a mining boom. When we go through mining booms, yes, there are costs associated with mining booms, such as other industries suffer and there's income inequality and all of those sorts of things. But generally speaking, the economy does go through a bit of a boom. Economic growth is strong, employment's strong, and wage growth is strong during a mining boom in Australia. Okay, remember, ignoring things like income inequality and inflation and all those other things. Generally, economic activity and employment are strong. So why are economic activity and employment strong? Because exports will be high and the level of foreign investment into Australian bond markets, so foreigners lending the mining companies money, and also foreign investment into Australia's stock market to earn the higher returns of mining and energy shares during that period, both of those sorts of investments increase. So if exports increase and foreign investment comes in, it's going to lead to a very strong appreciation of the Australian dollar. So good economic conditions, a lot of foreign investment comes in, it's going to drive the exchange rate up. And if the good economic conditions are a result of high levels of exports, that's even going to push the exchange rate up further. In contrast, if a country is in recession, there's not going to be very much foreign investment into that country's bond market or stock market. And indeed, a lot of people might actually sell their assets in the country that's underperforming, that's in a recession, and move that money out of the country to try to get a better return somewhere else. All of that will lead to a depreciation of the exchange rate of a country that's in recession. So strong country, strong currency. Now, getting back to this diagram, when Germany joined the euro currency, it became part of a group of European countries that were all using the euro. And so then you've got to ask yourself, well, what did the Deutschmark reflect? The Deutschmark reflected the economic, at any point in time, the world's perceived, or the world's perception of German economic health or strength at that time. So the Deutschmark, before the euro, represented the economic health of Germany. So what does the euro represent? Well, it must then represent the average economic health or strength of all of the countries that have adopted the euro. And so that's kind of the intuition as to why the euro currency was a weaker currency than the Deutschmark, or is a weaker currency than the Deutschmark. You've got strong countries like Germany pulling the value of the euro up, but then you've got the weaker countries pulling the value of the euro down. And so the value of the euro at any point in time is kind of going to reflect the average economic strength of all of the countries using the euro. So that's kind of the logic why the euro currency would be a weaker currency than the Deutschmark. And so in this diagram, when the euro was introduced in 1999, we can kind of model that as Germany going from using a currency, the Deutschmark DM, which was very strong relative to the US dollar, to using a euro currency, which was much weaker relative to the US dollar. And that explains much of the initial increase in net exports. So much of the increase in net exports from sort of 1999, where the current account deficit was sort of minus 1.5% of GDP, up to about here, where Germany very quickly adopted a new currency and started running very large current account surpluses. So this is a massive benefit for Germany. Adopting the euro and knowing that the other countries that are using the euro, other than Germany, particularly the southern countries in Europe, will actually weaken the euro to the benefit of Germany. And so what we can see here is in this graph, it's the euro exchange rate. Once again, it's the real effective exchange rate. You don't need to know what the real effective exchange rate is. It is obviously different to the normal everyday exchange rate, which is the nominal exchange rate. But what I'm pointing out here is that initially when the euro was introduced in 1999, there was some strength here through to the global financial crisis of 2008, 2009, which are now full bottles on. So the euro currency did appreciate. So if we come back to this graph, the easiest way to think of this big swing from current account deficit to current account surplus up to about this point, even though the euro was appreciating, the euro was still much lower than the Deutschmark. So what we've got here is, in a sense, at point A, it's just prior to the introduction of the euro in 1999. So say 1997, 98, we're at point A, or Germany's at point A. The euro is introduced and you get this sudden movement from an old strong currency to a new, much weaker currency. What this graph is suggesting is, however, in the early 1990s, there was a little bit of strength in the euro. But that strength in the euro wasn't enough to prevent Germany from really achieving large current account surpluses over that period. Then we go to the next part of this diagram. From around about 2009, which is the GFC, the euro really struggled. Over this period was the European debt crisis, and a lot of countries got into a lot of trouble. Governments got into trouble with high debt levels, and the euro really did weaken as a result of the European debt crisis after the global financial crisis in 2008, 2009. So this depreciation of the exchange rate here is consistent with, if we look at about 2009, this surge in the current account surplus to even higher levels. Now, one thing that may be confusing at this point is how Germany went from a current account deficit to increasing current account surpluses if the exchange rate or the exchange rate of the euro was appreciating over this time. And that might be a little bit hard to understand. The reason for that is really beyond the scope of this course. It's actually quite complex, and I want to just avoid getting into that. It's just going to, it would just take too long to actually work through it all. And as I said, it's just beyond the scope of the course. But there is a good reason. Yeah, but we just won't go into it. Just look at this and think to yourself, well, okay, in the 1990s, Germany was using the Deutschmark and had a negative savings investment imbalance. Then it adopted the euro. And so even though the euro appreciated, the euro was still so much weaker than the Deutschmark that Germany's export sector, despite an appreciation of the euro, was able to push forward and really increase exports significantly and push the German current account balance into a big surplus, despite the appreciation of the euro over that period. And then the next bit, we've kind of got a bit of a structural break here from about 2010 onwards. The GFC hit and Germany's current account surplus surged even higher following the GFC because of this depreciation of the euro. Okay, what we can see here is that we've got exports and imports here for Germany, and we can see around about 2000, around about 2001, exports really did open up and become much larger than imports, and that goes right through to 2019 and beyond. Even in the current year, Germany is still running large current account surpluses. And so this is just another visual showing when Germany's current account balance went into surplus, just to sort of reinforce the point. So what is the solution, the last part of this case study? Well, the problem is that Germany is at position B today, is at position B in this model. So it's got a level of net exports of, say, 80 billion. And let's imagine that's the current account surplus. I'm just using a number to illustrate the point here. These numbers aren't accurate. So it's got net exports and a current account surplus of, say, 80 billion. But then it's got a savings investment imbalance of, say, 50 billion. There's a gap. Now, we know that if savings are greater than investment, that $50 billion will be invested overseas. And most of that money does or is invested in the other countries of Europe. So that 50 billion is an outflow of money out of Germany. The 80 billion is an inflow of money. So Germany's in this rather unique situation where it has got an exchange rate which is not at equilibrium for Germany in this model. And so it's got a net inflow of money of $30 billion each year. Now, I was talking to a couple of Europeans a couple of years ago about this. And there is a sense in Europe that the euro is providing Germany with a hugely unfair advantage relative to the other countries of Europe. We can see why, because the euro for Germany is far undervalued. Germany has massive current account surpluses, and it's got a net inflow of money of 30 billion. So in a sense, it's kind of drawing in money from the other countries that use the euro, countries which are much poorer than Germany itself. So what's the solution? Well, the solution is to close this gap. The gap between that point and that point. Now, one way of doing that, eliminating this gap, well, first of all, you can't manipulate the euro. You can't look at this diagram and say, well, you could close that gap by pushing the euro up to the level of the Deutschmark. That can't be done because that level of intervention by the European Central Bank in foreign exchange markets is just not feasible. You can't manipulate your currency to that extent and hold it permanently at a higher level. It's just not possible. So the euro is the value that it is at. So we can't manipulate the euro and push it upwards to close that gap for Germany. If you did that, you would just plunge the export sectors of the other countries that have adopted the euro into crisis. Imagine pushing the euro up like that to close this gap for Germany. What would you be doing to the export sector, the tourism sector of Spain, Greece, Italy, Portugal? You'd be decimating their export sectors just to fix Germany. So obviously manipulation of the euro is not the answer. Now, one way would be to shift this green line to the right so that the green line now sits above $80 billion. So the Germans could then do that by saving more money or investing less. But the problem is that would just mean a higher level of net foreign investment for Germany. So the accumulation of more foreign assets for Germany, and its level of net exports would still stay at this very high level, and its current account surplus would stay at this very high level. It would just be balancing its economy by using all of this current account surplus revenue to then purchase even more assets, particularly within the other countries that use the euro. So that's not really a solution to the problem. So what has been suggested as possibly the only viable solution, given that you can't change the exchange rate, given that you can't move the S-I line to the right, because that involves even higher levels of German ownership of foreign assets, and that's not going to be politically acceptable. The only solution is take the NX curve and shift it to the left. So how do you do that? Well, you could do it by decreasing X or increasing M. So now you're a politician in Germany. An economist has told you that you've got this problem that you've been listening to for a while now. And the only way to solve this problem and close this gap between this point here, where the dotted line crosses the green line, and point B, that is the gap between savings minus investment and net exports at the current euro exchange rate. The only way to close that gap is shift the NX curve to the left. So you've got to either decrease X or increase M. Which are you going to do? Hopefully you've had a little bit of time to think about it. Let's just consider increasing imports. How are you going to do that? You're going to have to go along to German households and German businesses and basically force them to buy more imports than they would naturally purchase. So what are you going to do? Force German households to start holidaying, not in Bavaria, but in Italy? How are you going to do it? It'd be very difficult. You could probably think up some way of doing it, But the implementation of it would probably be politically very difficult, very unpopular, forcing companies and households to import more. It just sounds ridiculous to me. So we've given up the idea of importing more to shift the NX curve to the left. The only other option here is to export less. Well, how do you export less? That's actually a lot easier. As the government, you could work with the unions, and this has actually been suggested in Germany, work with the unions and work with employers to pay workers wage rises, substantial wage rises. Because with these high levels of net exports, the companies that are undertaking the exports, they're making a lot of money. And so you start paying workers more, significantly more, maybe 10, 15% more, maybe in some industries, 20% more. That will have the costs, that will have the effect of driving the costs of German producers, particularly exporters, up. And what they'll then have to do is, in response to those wage rises, increase the prices of the goods and services that they export. And with those price rises, you're naturally going to get a reduction in the level of foreign demand for German exports. So by paying workers more, pushing up production costs, and therefore the prices of goods and services that are exported from Germany, you can actually decrease net exports, and that would be modelled by a leftward shift in the NX curve. So this is a very big problem for Germany at the moment. Other countries, other weaker countries, they would sort of be in the opposite situation, if you can imagine what that would look like. But this is a problem that really needs to be addressed by Germany. They haven't addressed it substantially at the moment, but there is a lot of conversation about it. And hopefully you can see the problems that it is causing, not only for German people, but for the other countries that are on the other side of Germany's large current account surplus. Obviously, if Germany is running current account surpluses with a lot of other European countries, then they're running current account deficits with Germany. The final point to make is that this solution of pushing wages up in Germany while fixing its current account surplus problem, or going some way to addressing the current account surplus problem, would also benefit workers throughout Germany and improve their living standards. So these are the sorts of insights that this model and macroeconomics can actually provide. I think this is quite an interesting case study. Hopefully you'll agree with that. But this is an issue that's going on now, needs to be addressed. And it is causing a lot of friction within the various countries within Europe. There's a lot has been written about Germany's current account surplus. So if you're interested in digging into this a little bit deeper, then there's plenty to read on this issue. And it'll be an interesting issue to follow over the years ahead.